We'll review the 4 levels of option approval before you can actually trade, and the minimum requirements for selecting stocks suitable for options trading. The specific factors include volume, open interest, and bid and ask spreads for identifying the right stocks. So let's jump right in. So let's go through the different levels of option approval. Level 1 is the first and most basic level. At this level, you're allowed to do covered calls and cash secured puts. A covered call is when you already own a stock and you sell an option against it. This allows you to make extra money if the stock doesn't go up too much. A cash secured put is when you sell a put option and have enough money in your account to buy the underlying stock if it gets put to you. Level 2 gives you access to buying options. This means you can buy call or put options without owning the underlying stock. Buying options can give you more flexibility in your trading strategy. Level 3 is for option spreads. A spread is when you buy or sell options at the same time and the two options are related to each other. For example, a vertical spread is when you buy a call option at one strike price and sell a call option at a different strike price. These types of options are in fact the ones that I usually trade. At this level, you're allowed to do naked calls and naked puts. A naked call is when you sell a call option without owning the underlying stock. A naked put is when you sell a put option without having enough money in your account to buy the underlying stock if it gets put to you. These are riskier trades and require a lot more experience and financial resources. Remember, just because you have access to higher levels of option trading doesn't mean you should automatically start trading those levels. Make sure you have a solid understanding of the risks involved and always trade within your means. Now let's talk about the minimum guidelines for trading options. First, with volume. Volume refers to the number of option contracts that have been traded during a specific time period, such as a day or a week. As a general rule, it's good to look for options with a minimum daily volume of 100 contracts. This helps ensure that there are enough buyers and sellers in the market to execute your trades at a fair price. The number of options traded are reset daily, so you may see a small number of contracts at the beginning of the trading session and will increase throughout the day. 2 is open interest. Open interest refers to the total number of option contracts that are currently open. As a general rule, it's a good idea to look for options with a minimum open interest of 1,000 contracts. This helps ensure that there is sufficient liquidity in the market to trade the options you're interested in. Now let's talk about the bid and ask prices. The bid and ask prices refer to the prices which buyers and sellers are willing to trade options, while the ask price is the lowest prices sellers are willing to accept. As a general rule, it's a good idea to look for options with bid-ask spreads that are no wider than 5 cents. This helps ensure that you can enter and exit trades at a fair price without paying too much in the bid and ask spread. This is also referred to as slippage. Overall, these minimum guidelines can help you identify options that are suitable for trading. However, it's important to keep in mind that different options and trading strategies may have different requirements, and it's important for an option trader to be very familiar with the markets they trade. In summary, great option markets are characterized by high open interest, which is the total number of contracts that are open between buyers and sellers, volume, and narrow bid-ask spreads, which is a product of volume.